So, good afternoon. Honored to be here. Thanks to Emily, to Shiri, to Healy, and everyone. I don't take it for granted. I don't take it for granted that many honorable people from Africa decided. It's a decision to come to Israel at this time. For us, it's a very important signal. It's a very important symbol. And we truly appreciate this. And as you know, nobody is perfect. And I'm a macroeconomist. So when I think of investing in Africa and opportunities for Africa and capital flows into Africa, I have to begin with a top-down view. Okay, in terms of the macroeconomic fundamentals, the structure of the system, the financial system, and so on. Because for me, and I think, as indicated, I've been 3 years in Wall Street as chief emerging market economist for Deutsche Bank, and I know the global investment mentality, of course, is top-down. Not to mention nowadays that there is so much turbulence, so much uncertainty with the world economy. So I did my homework, and I tried to sort of think of what would be the things that if I meet Israeli investors or other investors could be relevant from this top-down perspective. So let me begin with the outlook for the sub-Saharan Africa from 2-3 weeks ago. By whom? Not more or not less than the International Monetary Fund. And I will tell you that, I can tell you that I was tremendously surprised. I was thinking that I'm going to see much more weakness transpiring in the text of the International Monetary Fund and emphasis on risks. There are risks, but again, from a macro perspective. So let me share with you. The outlook for sub-Saharan Africa is showing resilience. In Hebrew, chosen. Resilience, okay? Despite a challenging external environment with uneven prospects in commodity prices, as we all know, there are many economies that depend a lot on exports of commodities, still tight borrowing conditions. We all know that interest rates nowadays are not low and that credit markets are quite severe, and a deterioration in the global trade and aid landscape, okay? But resilience. Economic growth is projected to remain steady at 4.1% in 2025 with a modest pickup in 2026, okay? So more than 4% if you take it on average for the whole region, supported by, and here are very important concepts, macroeconomic stabilization and reform efforts in key economies. So again, this is a combination of two very important fundamentals: macro stabilization and reforms. Macro stabilization to deal with the short-term issues and vulnerabilities. Reforms to give more productivity, better lives, and so on and so forth. But this resilience cannot be taken for granted. Okay, and there are overlapping monetary, financial, external, and fiscal vulnerabilities that are present in much of the region. And what can I tell you? Everybody is vulnerable nowadays, even the United States and Europe, you just name it. Uncertainty persists and risks remain tilted to the downside. So according to the IMF, the distribution of risks is not symmetric. If you had to put an emphasis, it will be more on the downside. But now come two issues that I will want to discuss. And I'm sure that many of the honorable participants are much more experts on this that I can sort of deal with. But there is an effort or an attempt to do domestic revenue mobilization. So instead of relying too much on foreign resources of capital to try to mobilize funds domestically, which is a major challenge because the saving rate in these economies is not very high. And second, strengthen debt management, that this could further bolster macro stability and support the development needs, okay? So, a very nice picture from the IMF. You can see this couple that goes together, resilient growth, again, I was very surprised, more than 4% and stable. And vulnerabilities, you can see on the left-hand side the projected growth. Below, in the bottom part, policy recommendations, domestic resource mobilization and debt transparency. And on the right-hand side, some of the vulnerabilities, high debt levels and fiscal pressures and trade and aid shocks. Of course, the region is subject to many, many shocks. Here are some very good news for the world capital market environment for the region, okay? Sub-Saharan Africa sovereign yields. So what we have here is, suppose that some countries there would like to mobilize funds by issuing in foreign currencies, okay, in, let's say, dollars or euros. And the question is, what are the yields, what are the sovereign yields that they have to pay in the markets in order to be able to sell bonds, to sell debt, and mobilize funds? And of course, the higher this is, the greater the burden on the government, the greater the risk, and the lower will be the rating given to these countries by the rating agencies. So as you can see, lately, this has been coming down, and it is nowadays 8%, okay? So 8% are the sovereign yields in foreign currencies. Of course, it is a high number, but it used to be 14%, okay? So in some sense, this is the vote of the international, the global capital market. This is the vote of the global investor community about the risks and the investment, at least portfolio investment. I'm not talking about things that were discussed in previous sessions, FDI, foreign direct investment, but at least we have this. So, as you know, we economists look at the margin, and at the margin, things are improving, because the fact that these yields are coming down is extremely important. We mentioned before that there are vulnerabilities, and if you are a region that you have a relatively high level of debt, and foreign debt, of course, there is a problem of interest payments. And where do these interest payments come from? From the revenues of the government, okay? Because we are talking about sovereign debt, the debt of the sovereign, the government. So you have here a very interesting statistic, the percent of revenue, excluding grants, that it goes to interest payments. So the higher this number, the higher the burden on the budget of these countries, because funds that have to go to repay interest are funds that cannot go at the same time to go to education, to welfare, to infrastructures, and so on and so forth. So you can see that for the advanced countries, we are talking about 4 or 5% of revenues. Other emerging market developing economies, you can see in the middle, and sub-Saharan Africa, the dots are different countries, of course, and then the line is the average. You can see that, yes, there is a burden, okay, there, and so the economies have to raise those funds, and this is of extreme importance. So one of the points that were sort of mentioned and recommended, and again, I'm sure that our colleagues here have a strong say about it, is to try to shift to domestic financing. So, of course, should there be a domestic capital market that is operating well and so on and so forth, of course, it would be welcome to sort of reduce the pressure, the excess demand for funds from foreign countries, and then do it at home. So faced with high external borrowing costs and limited financial market access, governments across the region have increasingly shifted to domestic financing. Although this shift may help cushion external shocks and reduce the exchange rate risk, it has not proved a panacea. It's not a miracle. It's not something that can be done overnight. And there are two main reasons for this. Number one, the domestic cost of capital remains elevated. So when companies or when governments want to place debt, want to place government bonds, sovereign bonds, in the domestic market, of course, this puts pressure on interest rates, on domestic interest rates. So given that local financial markets are underdeveloped, and there is a shallow depth, there is fragmentation, there are some areas of illiquidity, and there are high transaction costs and lending spreads, these structural weaknesses raise financing costs for both governments and firms and constrain the capacity to absorb debt, particularly long-term instruments, and they may crowd out domestic investments. So once again, this is a very good vision about the future, but it has to be taken in a gradual way, because if you mobilize too many funds or attempt to mobilize in the domestic market, of course, this may raise interest rates. It has an impact on the banks, it has an impact on the borrowers, and so on and so forth. And again, from a macro perspective, we have to look at things in a general equilibrium and not just look at one specific item. Number two, the shift toward domestic financing creates new risks that need to be carefully managed. In other words, domestic bank holdings of sovereign debt are large and growing faster in sub-Saharan Africa than in the rest of the world. So when you do that and you place paper on the market, some of the entities that will be purchasing those are banks that on their asset side will be earning the interest, relatively high interest, that is going to be paid. But as you can imagine, should something happen to the ability of governments to serve that debt, this may, of course, constitute an element of fragility from the point of view of the banks. And the last thing you want is to have an unstable banking sector, okay? So as they say here, this bank sovereign nexus creates a vicious potential feedback loop. Deteriorating sovereign credit worthiness negatively affects the soundness of the banking sector, and this could further reduce already limited availability of private credit. So yes, I think I'm a strong believer in a shift to domestic financing, but as you know, in emerging markets, you need to do a management of risks in a very careful way. I'm sure you haven't noticed that I have an Argentine accent. I was born in Argentina and came to Israel at the age of 18, but followed in my capacity of Argentine and expert in emerging markets, things in Latin America. And if there is one example of rushing too fast and doing things not in a gradual way that then at the end was very bad news, is the example of Latin America, that in many cases they very quickly opened up capital inflows, exchange rate appreciation, and so on and so forth. So, what can I say? I strongly agree with all the comments from the previous sessions. Ladies and gentlemen, now more than ever, the international community needs to step up. Okay? The international community needs to step up. A strong, stable, and prosperous Africa is good for the whole world. Do you agree? Yes. Okay. And through 4 years of crisis, the region's perseverance has been notable. Again, resilience, the word of resilience, 4% growth, but buffers have been eroded, making it increasingly difficult to fend off future shocks. We are in a world of shocks, and a very important issue is to build a safety net of policies that, resilience, that can enable you to deal and to manage with these shocks. And of course, within Africa, this is especially true for fragile and conflict-affected states. There are states that are in conflict, we have to take into account, and there the fallout from economic shocks tends to be longer and more persistent. So in this context, sub-Saharan Africa's broader prosperity is far from guaranteed. One cannot guarantee that. It is things are promising, but it will depend in part on continuous external support. So I think that the domestic homework is no doubt more stabilization, more reforms, more development, reasonable and common sense government, and so on and so forth, openness to competition with the world. And once these conditions develop and become stronger, the capital will come in. Capital will come in. The world is full of capital. And one has to take into account that the rates of return in the US or Europe are relatively small compared to the potential rates of return in areas like this. So once again, among other things, the development of Africa will require financial support from bilateral and multilateral entities. And now I want to mention a word that has not appeared yet this morning, and it is generative AI. And it is to point out the fact that we are all living in a historic moment. We are living in the context of a major technological and industrial revolution, something that happens once every 67 years, okay? And I tell my students at the university, listen guys, you will be able to tell your daughters and your children that you lived in a very historic moment, okay? And of course, at the center of this, generative AI. So research by McKinsey, for example, suggests that African economies could unlock up to $100 billion in annual economic value across multiple sectors from generative AI alone. Africa is not lagging behind. This is very interesting. Several organizations in Africa have already implemented AI and generative AI at scale and fully transformed workflows. An example, in Nigeria, a mobile telecommunications provider has scaled a chatbot that improved customer experience, okay? And there are more and more entities. There is, among the sectors that are most likely to adopt Gen AI are, of course, technology, telecommunications, retail, and financial services. And as you know, the sky is the limit, because Gen AI goes to medical, to agriculture, goes to education, and so on and so forth. And here there is something very important to emphasize, that there is an opportunity for the public sector to sort of strengthen the whole process of digitalization, to become more efficient, okay? And to improve experience and service delivery for citizens, patients, and students, and boosting productivity in entities. So in thinking about potential avenues for cooperation, collaboration between Israel and Africa and Israel, I have no doubt that coming from a so-called startup nation, we should be able to help the whole transformation of the ecosystem, in many of the countries in Africa, to take advantage of this technological revolution that, of course, will be for the benefit of everyone involved, including the private sector. Thank you very much.